So at this particular point in the economic cycle, we're kind of standing at a position where there's kind of a dual element going on in the economy. This particular year, 2022, has actually been a stronger year than we had expected. During the year, we've had quite a notable uptick in the performance of a number of key elements of the Irish economy. The household sector, in terms of consumption expenditure, has been stronger than we had expected earlier in the year to date. So even in the face of the cost of living pressures, households have continued to spend at a rate that we hadn't expected during the year. There's also been a very strong investment performance on a broad-based basis. You know, there's been a large commitment of capital into the Irish economy, in particular by the multinational sector, and there's been very strong export growth, a continued strong export growth in the Irish economy. So all of those factors together have led us to revise our expectations for 2022 for this present year. And that will be revised in an upward fashion. That's contrasted with the outlook. There's considerable headwinds and clouds on the horizon for next year. The international economy is slowing markedly, and that's driven by a number of different factors. In particular, if you think about the ongoing slowdowns in some of our major trading partners, in particular the US, UK, and the EU, you know, driven by the increases in energy prices, the rise in inflation, then the rise in central bank policy rates to try and combat the inflationary pressures. All of these factors are combining to lower the growth outlook for next year. So we are passing that through, you know, small open economy like Ireland. You know, you know, when the international economy slows, this passes through into the Irish economy. So all of this together, we're slowing our outlook for next year, and relative to our forecast earlier in the year. So if you look at this current screen shot here, you've got the forecast table on the right-hand side. You can see GDP and modified domestic demand forecasts are both presented. The modified domestic demand, just to recap, that captures household consumption, government expenditure, and also the component of investment that's not related to aircraft leasing or the intangible R&D capital. So it's a more narrow measure of investment that's included in the modified domestic demand. You can see with our forecasts for both of those particular components for 2022, they're really strong. You know, we're forecasting double-digit GDP growth for this year. Again, as I've said, on the back of the very strong investment, very strong employment activity, you know, we're pushing into double digits for GDP for this year. And for modified, making out some of the internationalized factors in the investment series, there's still very strong modified domestic demand. And that's coming from, you know, the particularly strong modified investment figures, but also stronger than anticipated household consumption in the present year. So very, very strong economic forces at play in the domestic economy at present. You know, however, we are slowing our trajectory very notably. You can see our GDP forecast is down to 3% for next year, and our modified domestic demand forecast for next year is just over 2%. We at this point are not expecting you know, the economy to slip into recession at this point. However, the reduction in the growth rate is very considerable from 22 into 23, and that really reflects our expectation at this point, given the existing data, of quite a slowdown in the growth performance for next year. And that really is related to the persistent cost of living pressures that households are facing, the effects that the input cost increases are having on business performance, and then again the second round effects of the rising interest rates, which are likely to slow investment, slow consumption, and also to put pressure on existing borrowers in terms of their capacity to cover repayments, and that's a key factor for next year. That notwithstanding, as you'll see later, you know, we enter this period of a slowing international economy and slowing domestic economy, with a very strong labor market, with the near historical lows in the unemployment rate, and also in a position of considerable strength for the public finances, with particular scope to be able to deal with these pressures, in particular from the cost of living. You will hopefully have all seen a new publication we've started over the past number of months is to present a nowcast for modified domestic demand. Now, what a nowcast is it tries to take all of the timely, up-to-date information and leading indicators that we can get for the Irish economy, and it attempts to model an outlook within the present quarter for modified domestic demand. And you can see the chart here, which shows the dark blue bar as the actual modified domestic demand outturn, and then the light blue bar as the model fit. You can see the model does a really good job of predicting the outturn for modified domestic demand. Now, what's very clear when you look at the nowcast for the fourth quarter of this year is that the downward trajectory that we've seen in the past number of quarters is carrying through. So there's a very clear evidence of a slowing pace in the domestic economy, and that's really one of the key indicators we're using to build into our outlook for next year. Is this continued downward trajectory of the modified domestic demand outturn in the nowcast, and it's very clear this is pointing towards slower growth going forward. That notwithstanding, one of the key elements of strength that we've seen of the past number of years in the Irish economy has been, the really well-performing ICT sector and the really well-performing pharma sector. And, it's certainly a long-standing strength of the Irish economy that we've had these very large multinational firms and this very strong multinational sector that has allowed us to grow in hasn't necessarily been as strong. So certainly the FDI component of the Irish economy has been really beneficial in terms of the broad growth outlook for Ireland. However, much of the recent outturns in the ICT sector internationally point to some risks for Ireland from that, from rationalisation or shrinkage in the sector. And one of the elements we wanted to cover in this particular commentary was to try and think about what sort of output at risk is there from the ICT sector for the Irish economy, given the growing importance of the sector over the past number of years. I think there's a couple of characteristics of the sector that are really important to point out. It is extremely high in terms of its labor productivity. You can see the chart there presented. This looks at gross value added, excuse me, per worker. So gross value added is the additional contribution of the industry to overall value added in the economy. And when you measure that per worker, that's a good measure of labor productivity. And you can see Ireland in the green line going all the way back to 1995, focusing on the ICT sector. Up till the late 2000s, it had a GVA per worker in the ICT sector, which was in line higher, but reasonably in line with the other European economies. But since then, the output per worker has really increased quite notably for Ireland relative to other economies. And this is, while this is a key strength, it is also a key weakness when you think about if this is driven by increases in intangible capital, and those capitals flows could reverse, then there could be some reversal in this. So this is one of the key elements that we're noting as a potential risk if the ICT sector it goes into any sort of prolonged downturn. I think it's notable if you think about the shares of overall value added the ICT accounts for. In 2009 it was about 8%, and that's increased quite rapidly to over 15% in 2019. So you can see the sector's really increasing in importance to the Irish economy overall. With that in mind, one of the elements we wanted to try and look at was to think about, well, what would the contribution to the Irish economy for from the ICT sector if the productivity in the sector looked more like other economies rather than what we saw as the kind of supercharged sector in Ireland. So we produced in a box in the commentary a counterfactual gross value added in Ireland, which took the employment levels that we have in ICT, but instead of the gross value added per worker from Ireland, it used the Belgian labour productivity, that being the second highest. And what you can see there is that in 2019, the total value added in Ireland was about 12.5% higher in actual terms than the counterfactual. So there is a key element of super growth in the ICT sector relative to other economies, which also would have reasonably high productivity. So I think the key element that we are trying to highlight with this box is that, while the ICT sector has been really important for Ireland, it's acted as an insulation policy for the domestic growth. The sector contributes a huge degree of corporation tax. It contributes strongly to income tax receipts, but there is a key risk that you could have a retrenchment in output if the sector consolidates or some of these intangible assets were to move outside the economy. So I think this is a key risk we wanted to highlight with this particular box. To move more to the traditional factors, as I mentioned earlier, we are forecasting an increase in household spending for this year relative to our previous commentary. You're expecting consumption to grow by 5.8% this year, and that is taking into consideration the increase in the cost of living. So Irish households have really been spending quite strongly in the present year, and we do expect for the full year this year to have quite a strong outturn in consumption. However, we do see the rate of growth declining across many of the key indicators. For example, the retail sales indicators from the CSO are tipping downwards in the past couple of months. And this isn't unexpected, given the rising cost of living and the challenges that many households are going to face next year in terms of their ability to have sufficient income to cover their expenses. And certainly for next year, we see much slower growth in consumption, at 2.1% relative to nearly 6% this year, as some of these factors bite. So households will have less disposable income. Households who are maybe on higher incomes may engage in precautionary savings. So all of these factors are likely to pull down the expenditure by households next year in real terms. One of the buffers that we have built in to our forecasts over the past number of quarters is the very high savings ratio. You can see it there in the chart. It's been quite a feature of the Irish pandemic economy, is that very high household savings have been recorded. However, the recent note by the Fiscal Council, which points to the fact that there may be some overestimation of savings levels relative to incomes, we're building that into our forecast and not expecting as rapid a decline in the savings ratio overall for next year. And this is leading to our this buffer that we thought households would have in terms of the savings levels to draw on. We're not assuming as high a buffer there in our outlook for next year. In terms of investment for this year, you can see the forecast table there. With very strong increases in overall investment in the economy. There was a quite notable increase across all of the non-R&D, non-aircraft leasing asset classes, and we're expecting very strong outturn for this year. When we think of the construction investment, we're looking at a very strong housing completions number for this year, the strongest in many years. We're forecasting about 28,000 units to be completed this year. That's the highest for many years, and it could be a little bit higher this year depending on how the fourth quarter goes. But certainly the construction output for this year has been very strong. The other investment items, you can see the non-modified construction investment in the chart here, which is in the green bar. That has also been rising in the first part of this year, which really reflects the strong commitment of capital, particularly by some of the FDI enterprises into the Irish economy, and that's buying plant, machinery, other equipment, data centers. This type of investment has been very strong in the Irish economy. I think our outlook for next year, however, is much more muted. The growing international slowdown, the rising interest rates, all of these factors are going to be affecting firms' investment planning. It'll affect their the profitability of new capital commitments, and all of this we're building into much slower investment next year. We do expect investment to grow both in overall terms and in modified terms, but we are we are forecasting a major reduction in the growth rate of investment for next year. In terms of housing completions for next year, we are also expecting a slowdown. Housing completions have been shown to be very sensitive to cost inputs, and they've been rising quite rapidly in the construction sector in the past year. So we are expecting demand side pressures also to moderate in the interest rate rise. Makes credit more expensive for borrowers, but also these supply side factors such as the rising input costs and potential labor shortages next year are likely to bite for the construction sector. So we're expecting a lower number of completions at this stage for next year. In terms of the traded sector, we are seeing this year very strong export growth, continued strong export growth. For this year, we're expecting nearly 13% export growth, which again is remarkably strong. If you look at other economies globally, this is really quite a remarkable outturn. But I think Ireland is very particular in the concentration of our exports in two particularly globalized sectors, the pharma and the ICT, and that's really pulling up the trade figures for this year. For next year, we are noting quite a slowdown, reflecting the deterioration in the international conditions. Also some of the broader uncertainties from the war in Ukraine and the under geopolitical tensions. We are expecting trade to slow next year in terms of export growth, but still posting over 5%, which is strong relative to other economies. For this year, we have seen quite an increase in imports. That is to do in part with big imports of intangible capital we saw in the third quarter, but also it's to reflect the rising domestic economy, which will lead through into increased imports as well. So we are seeing quite a pickup in imports for this year, and we are forecasting quite strong imports for next year. I think to maybe just challenges, sectors are increasingly important for Ireland. They're really strong contributors to output. They've really strong employment in the economy, but we are looking at over half of our exports being accounted for by these two particular sectors, which does leave us vulnerable to any international downturns, which changes the course of the performance of these two particular sectors. Okay, with that, I'll hand over to Kieran to talk through the labour market and the public finances.
Thanks, Conor. We continue to see very strong performance by the Irish labour market, as we've seen unemployment down to 4.4% in November, which is pretty much at almost a historical low. Next year, we continue to expect to see unemployment to fall, although at a much slower pace. So we see unemployment falling to just 4.3% on average next year, and that reflects the slowdown in the growth rate that Conor was talking about there. Since the pandemic, we've seen a recovery in employment across most sectors, but not all. The accommodation and food service has actually lower levels of employment now than what it had back in 2019. And the discrepancy in recovery across sectors has led to large differences in earnings growth. It's interesting, we have a chart in the commentary in terms of looking at employment growth according to the different sectors. And what's noticeable, particularly noticeable, is the most recent data for the ICT sector, where you've seen 11,000 fewer jobs in Q3 relative to Q2. So this just again tallies with this issue of the concentration risk and the extent to which the economy is hugely dependent on these sectors. And when either sector, the ICT or pharma sector, experiences a particular shock, it does have and could have significant implications for the domestic economy. On the public finances, of course, we've seen continued strength in terms of receipts. All of the major headings have registered very, very strong growth. But of course, the corporation tax is the one that stands out at 56% year on year for the year to November, which is really quite extraordinary given the increase in tax receipts from this source over the last number of years. You know, we can only really speculate as to the reason for this. It may well be that you know, some of the multinationals have been using obviously capital allowances as a way of reducing their taxable profits over the last number of years. Some of those capital allowances, maybe the schemes behind them may be coming to an end. Hence, there may be higher levels of profit now being taxed. But there's no doubt it is providing the revenue, the government receipts with a huge boost over the last number of years. As a result, there is obviously the ongoing issue as to the question marks about the sustainability or otherwise of the receipts. And for that reason, we do welcome the government's contingency fund and the amounts being diverted to it. For this year and next year, we continue. Our forecast for corporation tax next year is very, very modest. So we don't expect to see anything like the same increase next year that we did this year. But overall, we expect the public finances to be in quite a healthy state this year and next year in terms of, you can see there are forecast percentage of GDP in terms of the general government balance. So 0.7% this year, rising to 1.3% next year. And that is including the diversion of funds to the contingency fund. So the public finances on the face of it are in quite a good position. As we said before, that does allow the government, if it does need to use supplementary welfare measures next year to combat the cost of living issues, it does have the resources to do that, or is likely to have the resources to do that next year. But again, as I said, underpinning these public finances, of course, is the very strong performance of the corporation tax sector. We devote quite a bit of time in the commentary to financial sector issues, particularly, I suppose, in light of the rising interest rates that we've observed because of the inflationary pressures. So one of the issues we look at is the whole concept of interest rate pass-through in the euro area. So we actually model this, including Ireland, amongst a variety of euro area countries. And what we see, unsurprisingly, is that the rate of pass-through, so that's the extent to which the policy rate changes at the euro area level, the ECB policy rate changes, the extent to which that feeds through to the mortgage market in Ireland is quite reduced, if you like, or quite small compared to the way in which it feeds through to other mortgage markets across the euro area. We find that, particularly for the likes of ourselves, Greece and other countries, that the pass-through effect is quite limited. This really is due to the financial crisis, the lingering effects of the financial crisis. And the box describes how it's partially, we feel, due to issues around competition, the lack of competition in the Irish market. And it's also due to the legacy issues concerning the amount of non-performing loans on the balance sheets of financial institutions, which, of course, affects their capital levels and the way in which capital levels are determined. So those two factors, I think, are still, which are legacy effects of the financial crisis, still impacting this rate of pass-through from the euro area policy rate to domestic mortgage rates. The other issue we look at in another box is issues concerning the debt service ratio. So this is a particular concept that's used, favored by international agencies, to look at leverage levels amongst households. It's basically a combination of the loan to income ratio and interest rates, mortgage interest rates. So what we do is we look at this in an Irish context and chart how it has changed through time. And you can see the chart there, the extent to which the debt service ratio really increased substantially during the financial crisis and then came back down afterwards as loan levels in particular fell and interest rates also eased after the financial crisis. There's obviously two factors that we're looking at in terms of we do some kind of future forecasts of that ratio. One is the change in the central bank's macroprudential regime recently. So for first-time buyers, the debt-to-income ratio or the loan-to-income ratio has gone from 3.5 to 4. So we think between that and the fact that interest rates are going to continue to increase, we think the debt service ratio for households in an Irish context is going to increase over the next year or so. It's not going to go back up to the levels it was at prior to the financial crisis, but it is a noticeable pickup compared to where it's been over the last 7 or 8 years. And so we think that's somewhat notable in terms of, you know, how household leverage levels have really been falling and consistently at a consistently relatively low level over the last 8 or 9 years. But these two factors could see the debt service ratio increase over the next year or so. In terms of SME lending, again, it's interesting just when you put the little bits of puzzles of the Irish economy and the underlying story together, when you tally the employment situation with kind of credit to the SME sector, you can see the sectors that are performing well and those that aren't. And what's noticeable about credit levels is that for a lot of sectors, the lending that's going into these sectors is less now than what it was in 2019 prior to the pandemic. We see that in the real estate sector, and we see it for hotels, restaurants, and other services. So the lending, total lending in these sectors in 2022 is lower than what it was in 2019. There are some sectors which have seen a recovery in lending levels, but as I said, when you tally this with some of the sectoral employment levels, I think you really get a picture as to how the domestic economy is, the different manner or the way in which the domestic economy is performing in terms of the differing growth rates across the variety of different sectors. Then if we just go on to look at inflation, so we have revised up our inflation outlook slightly from the last commentary as far as next year is concerned. So last time out, we were saying inflation at 6.8. We're now saying inflation at around 7.1 for next year. So that's still quite an elevated inflation rate. That's really a combination of two factors. On the one hand, it's base effects following through or carrying through from this year into next year. And we also build on some deep analysis that our colleagues, Paul Egan and Adele Bergen, did on the effects of the Ukrainian crisis, and Conor was involved in that as well, on the Irish economy, and part of what they looked at was the impact on inflation. So overall, then we see the inflation rate at 7.1% next year. However, there is an upside risk to that, if you like, and by upside risk I mean that you could have a significantly lower inflation rate if you see a de-escalation in the war in the Ukraine, or changes within energy markets. You could see inflation falling at a faster pace than is anticipated, but that at present, that's our outlook for next year. So therefore, in terms of the assessment, two other pieces of analysis worth mentioning. First of all is a paper by our colleagues in the tax welfare program, and tax welfare and pensions program. And this is their customary kind of detailed micro level analysis of the budget. And again, they do their customary kind of distributional impact of the budgetary measures and kind of forecasting those into next year. Overall, I think their conclusions are that the budgetary measures will help to insulate family incomes relative to a kind of a price-adjusted benchmark as of when the analysis was done. However, there may be need for more one-off cost of living measures into 2023 if price pressures persist. And so it really all boils down to the rate of inflation next year in terms of whether there's more government measures, more government supports required in order to insulate family incomes. And as we said in the public finances section, there is some capacity there to do that. So the government is in a reasonably fortuitous position as far as the public finances are concerned. On the public finances, we do welcome the establishment of the kind of the rainy day fund, or the windfall taxes being diverted into a fund. However, we do think that there needs to be some degree of clarity and transparency around how the quantity of funds that are moved into this, or quantity of receipts that are moved into this fund. They are substantial sums of money, and I think we need to understand how and why the amounts concerned are being moved in. So how is it estimated? What's the rationale behind it, etc. Just to provide some transparency on that. A further box in the commentary, continuing our kind of climate change emphasis, if you like, in the commentary, looks at the introduction of aviation taxes and examines a variety of options in that regard in terms of achieving climate change proposals. So this is by our colleagues Kelly de Brun and Mert Yakut, using their model, their I3E model, to kind of simulate these changes, and in terms of evaluating what's the best, most effective way of achieving these climate change proposals, And they kind of come down on the suggestion that the European Union's emissions trading system, the ETS, that revisions of that system are the best way and most cost-effective way of reducing emissions. And so I think it's a very interesting box in terms of its analysis, in terms of looking at this particular issue. So finally, then, just in terms of the overall assessment, the risks going forward, I think, are well known. High inflation, the recessionary risks amongst large economies. Increases in monetary policy rates clearly are going to have an effect if the ECB continues with those rate changes into the new year. And of course, that's all conditional on the rate of inflation. And I think in particular, as to how the domestic economy is impacted by global recessionary trends, that will ultimately depend on how the key sectors of ICT and pharma are impacted. And that really has been the story of the domestic economy over the last couple of years. In terms of our headline forecast, then, we actually revise up slightly our forecast for this year. So we expect GDP and MDD, modified domestic demand, to increase at 10.8 and 8.4 respectively. And for next year, we expect them to grow at a much more modest rate, GDP growing at 3% and MDD growing at 2.2%.